Right, so welcome to another episode in our discussion where we try to bring the classroom to practice. And today we are looking at the 2024 Auditors Report of the Republic of Ghana because the report has been issued. And then, as always, there are various concerns that have been raised on the Auditors Report. But if you are somebody sitting for the ICA examination and you are writing subjects such as public sector accounting and finance, advanced audit and assurance, management accounting, and even financial management, then there are a couple of things that you need to understand in respect of the Auditor General's report. There are a lot of things there that links to what we are learning in class because having the understanding that what you are learning is what is seen in practice increases your chances of understanding what you are learning and put you in the position to ultimately pass the examination. And so in this episode, I am going to be walking you through the key findings in the auditor's report that relate to the ICAG professional qualification examination in public sector, advanced audit and assurance, management accounting, financial management, and other key areas, showing you how some of those things are practically applicable and how the Auditor General raised concern on some of the things that have been declared and recognized in the financial statement of the Republic of Ghana. And I believe it's a session that you're going to love and we're going to be going through a lot of things. Remember to share the video with others and subscribe to the channel and stay connected because we're going to be releasing a lot of videos such as this to help you to understand the difference between what you are learning in the syllabus, what we discuss in class, and how practical they are at the workplace so that you increase your chances of putting yourself in the position to understand it and merging the classroom with what goes on in practice. So let's get into the discussion and let's find out the few things that the Auditor General has raised concern on when it comes to the financial statement of the Republic of Ghana for the year ended 31st December 2024. Now, the actual report is around 864 pages or so, but certainly we cannot sit down to go through 800 and over 800 pages of document. And so what I've done is to leverage AI with specific prompts on key issues that I want to find out and how they relate to the syllabus. And that is what I want to share with you. So this is actually a condensed version of the actual document, focusing on those key areas that are applicable for our examination if you are writing public sector, advanced audit and assurance, financial management, or even management accounting, then it is important you have an understanding of these things. Now, so this report, as I mentioned, is for the public accounts of Ghana for the year ended 31st December 2024. And for starters, in advanced audit and assurance, the auditor issued a qualified opinion on the whole of government account for the year ended. Now, if you are in audit, you know that there are four types of opinion that can be issued, two types of reports that can be prepared, modified report, unmodified report. An unmodified report is where the auditor issued an unqualified opinion, which means the financial statement taken as a whole represents the true and fair view of the entity. But in a modified audit report, the auditor can either issue a qualified opinion, which is an except for opinion, a disclaimer opinion, or a diverse opinion. Now, the modification of the audit report depends on a number of things. Number one, the materiality of the subject matter in question, the pervasiveness of the subject matter, that is the ability of the subject matter to affect or what effect the subject matter has on the financial statement taken as a whole. And then number three, the ability of the auditor to obtain sufficient appropriate audit evidence. And so in this report, the auditor issued a qualified opinion, which means that, when we take the whole government account, not everything is okay. There are some things okay, except a number of things. And those things the auditor has raised concern on that we need to understand in that case. Now, the primary issue leading to the qualification of the opinion includes a number of things. Number one, overstatement of public debt, misclassification of impairment loss as provisions for investment, the lack of impairment review of tangible and intangible fixed assets, and unreconciled intercompany account balances. And so these are some of the reasons, these are some of the things that resulted into the issuance of the qualified opinion, and we're going to be getting into them in a moment. You know already that when it comes to Ghana, one of the primary responsibilities of the Controller Accountant General is the preparation of the annual account. So the Controller Accountant General holds the statutory mandate to prepare and submit the consolidated annual accounts of the government. And this responsibility is stipulated in Section 81, Clause 1 of the Public Financial Management Act 2016, Act 921, and further detailed in Regulation 217 of the Public Financial Management Regulations 2019, LI 2378. Now, if you're a public sector accounting and finance student, or you're a management accounting student, or you are a financial management student, you are going to be hearing about these acts because they are primary acts that we are going to be referring to during the discussion in the class in respect of these. And so these acts together gives us the mandate of who is responsible for the preparation of the annual financial statement or annual report of the government of Ghana. And that responsibility is with the Controller Accountant General. Not only that, the financial statements or the annual report must be presented or must be submitted to the Minister of Finance and the Auditor-General at least 3 months or within 3 months after the year end, and that will include everything that relates to the government's activity in that case. Let's now focus on the 2024. For the 2024 financial year, the whole government account included the financial operations of 1,274 entities. So what the Auditor General is reporting on is financial statements report prepared by the Controller Accountant General on 1,274 entities. Now, these entities comprise the following: 883 ministries, departments, and agencies, 261 metropolitan municipal and district assemblies, 87 GBEs, and state-owned enterprises, alongside 83 centralized data groups, aiming to provide a holistic view of the government's financial activities. And so the 1,274 is made up of the ministries, department, agencies, metropolitan municipal and district assemblies, government, business, enterprises, and SOEs, that is state-owned enterprises, and other centralized organizations. So what we are coming to talk about, what we are going to discuss, is not just about a covered entity. It's not just about maybe a ministry. It is about the whole country, the whole government as much as possible in that case. So what are the things we need to be mindful of? The first thing we need to be mindful of is in respect of the accounting framework here in Ghana, right? Primarily here in Ghana, the whole government accounts were prepared on the accrual basis in full accordance with the International Public Sector Accounting Standards, which is the IPSAS. And so if you're in the public sector class, you're going to be hearing a lot about IPSAS, IPSAS 16, IPSAS 17, IPSAS 2, IPSAS 3, IPSAS 5. We're going to be getting into all of these things. And so accrual basis of accounting. Now, you got to be careful, because if the financial statements are prepared on accrual basis, then it means any revenue owing must be recognized in the books of the books, right? Any revenue outstanding should be recognized. The entity must undertake impairment testing. The entity must ensure that everything is recognized in the books on the accrual basis, not on the cash basis of accounting. And that is crucial for us to understand. Beyond the IPSAS, the legal foundation for public financial management in Ghana is established in the Public Financial Management Act 2016, Act 921, and its accompanying regulations 2019 LI 2378. And so the IPSAS full accrual basis, then the legal framework, Public Financial Management Act, and LI 2378. Now, when it comes to the chart of accounts of government, another thing you're going to be looking at the way financial transactions are supposed to be categorized. It is going to be categorized based on the chart of accounts as developed by the United Nations Statistics Division. All right. And that has been integrated into the Ghana's chart of accounts. And so the comprehensive Government of Ghana chart of accounts is designed to ensure consistency with the IPSAS, Government Finance Statistics, GFS, and then COVOC, which is Classification of Functions of Government, providing a structured approach for recording, classifying all budget and accounting transactions. Now, the reason why this is important is because, especially those of you in the public sector accounting class, you are going to be coming along with this because remember, we are going to be having a dedicated question, 20 marks on the preparation of the financial statement. Then we're going to have a dedicated question, 20 marks on the IPSAS. Now, the way we recognize items, the way we classify items in the books, in the financial statement, will be in accordance with the guidelines in the IPSAS, in accordance with the government finance statistics, and then also the COVOC. And so we are going to be using these in the public sector class. When we are preparing financial statement, we will use it when we are recognizing transactions in accordance with in accordance with the IPSAS that we need to know about. And so those are the things that we need to understand when it comes to the foundational accounting framework. Yes, the law is there, IPSAS is there, then some general guiding principles also there to help us in the preparation of the financial statement. Then we come to roles and responsibilities because if you remember, if we are talking about financial statements, there are maybe 3 or 4 people we need to be talking about. The first one will be the Controller Accountant General. He's the one who is going to be preparing the financial statement. So the Controller Accountant General is primarily responsible for the preparation and fair presentation of whole of government financial statement. I need you to be careful here, fair presentation, because remember, qualitative characteristics of financial statement, faithful representation of financial statement, relevance, right, comparability, verifiability. So the financial statement must be prepared, and to be useful, they must have those qualitative characteristics, those attributes. And so it is the Controller Accountant General's responsibility to prepare and fairly present the financial statement of the government. What does that mean? It means that the financial statement prepared by the Controller Accountant General must be in accordance with the IPSAS, the Public Financial Management Act 2016, and any other regulations or directives that guides the preparation and presentation of financial statement. But in addition to the financial statement preparation, the Controller Accountant General also establishes and maintains the necessary internal controls to ensure that financial statements are free from material misstatement, whether arising from fraud and errors. And so, who makes sure that there are effective and efficient internal controls within the organization? That is the job of the Controller Accountant General as well, working in line with the internal auditors in the organization and the principal spending officer or principal account holder to ensure that things are being done well within the organization. And the reason why that is important is because so that we can avoid fraud, make sure that the financial statements are fairly presented, and most importantly, ensure that we are not misleading the users of the financial statement so that by the time before the Auditor General comes, things are figured out, things are done already, and we are not going to be having any problems at the end of the day. That is what we need to understand. On the other hand, the Auditor General is coming in to independently provide assurance on these financial statements. That's it. Okay? And that means examining the financial statement and certifying in their opinion whether the financial statement presents financial information in accordance with the government accounting policies and consistent with the best practices as by Section 15 of the Audit Service Act 2000, Act 584. Then also, the Auditor General's authority to audit the financial statement is again enshrined in Article 187, Clause 2 of the 1992 Constitution, Section 80, Clause 4 of the Public Financial Management Act 2016, Act 921, and Section 11 of the Audit Service Act. And in all these, the auditor is expected to maintain high level of independence because, the auditor cannot be involved in the preparation of the financial statement and then comes and audits the financial statement, right? So the principle of independence is key here, and the Auditor General cannot be seen to be forced to do things contrary to what is expected to be done, and the Auditor General cannot be put in any position that will impair his or her professional judgment. Now, the distinction of this role is important because it is a fundamental thing for good governance and accountability. If we don't have an independent person to look at the financial statement, then we cannot assess accountability. We cannot hold government accountable, and we cannot assess any good governance issue. And even after the Auditor General's work, we have another layer, which is the Public Accounts Committee. And so the Public Accounts Committee is also going to be coming in after the Auditor General's report and take various action, call people before them, and then, do whatever they have to do. In addition to that, we have civil society organizations who are also there to carry out their responsibilities to ensure that everything is done well. So the distinction of this role is important. Just like how in the private sector, the management are responsible for the preparation of the financial statement. When they are done, shareholders approve the appointment of auditors to come and independently examine the financial statement. It is not that the shareholders do not trust management. They are doing that because they want to find out, are the management running the company in their best interest or not? It is the same thing that we are trying to do in the public sector, where the Auditor General must be seen to be independent to ensure we achieve good governance and be able to hold government accountable. So the key question is, what are the critical findings and their implication on financial reporting and compliance? And we're going to be dividing this into a number of groups. And the first one we want to look at is issues impacting financial position, accuracy, and fair presentation. Because the financial position of the government is crucial. It helps us to assess the liquidity position, the financial risk exposure of government. It helps government to make various decisions, whether it can borrow, it cannot borrow. It helps providers of finance, IMF, World Bank, other financial institutions to decide whether to lend money to the government or not. And then it helps policymakers generally to decide what policies can be made, how do we get our finances, and also generally decide on the going concern, the ability of government to be able to have the necessary finance to pay for its activities. And so the financial position, accuracy, and fair presentation is crucial. But there were a lot of issues that the Auditor General found during the audit that raised doubt on the accuracy and fair presentation of the financial position. And these are the issues we want to consider first. Number one, overstatement of public debt. Now, if you're in this country, one of the things you've heard is, hey, the previous administration, they've borrowed. Yeah, they've borrowed. But as per the Auditor General's report for the December 2024 fiscal year, public debt has been overstated by 139.91 billion Ghana cedi. Why is this the case? Because per the whole government account, there was a total of about 876 billion Ghana cedi of debt, but the Ministry of Finance records indicate a lower figure of 737 billion Ghana cedi, which means that there was a significant discrepancy. Why was this an issue? Because this is a direct violation of IPSAS what? 1, which mandates the faithful representation of an entity's financial position. And Section 54 of the Public Financial Management Act 2016, Act 921, which require full and accurate reporting of public debt. So, overstating the public debt by 138, almost 139 billion Ghana cedi is in contravention with the IPSAS 1. It's against Section 54 of the Public Financial Management Act. Now, IPSAS 35 also requires the inclusion of control entities in consolidated financial statements. And so the overstatement is attributed potentially to data aggregation errors or the inclusion of unverified obligation during the consolidation process. So a number of things could be at play there. Maybe, the figures were not added well, right? Maybe some debts were included that had not been verified, right? But have been included. The impact of this is profound because 130, how much? 139 billion Ghana cedi. That's significant because that raises our debt to GDP ratio. And so this error is profound. It undermines the accuracy and credibility of the financial statements, potentially misleading key stakeholders, including policymakers, investors, and development partners. This was explicitly cited as a primary reason for the qualified audit opinion. Because right now, what it means is that if government is going to borrow money, they're going to be careful, right? When any development partner or investors or World Bank, IMF, they are assessing the financial risk exposure of the country, debt to GDP and various issues, it's going to be overstated, which means it will affect government in making policies, in making decisions. Now, what did the Controller Accountant General say? The Controller Accountant General acknowledged the audit recommendation, stating that new event impact the figures were discovered after the whole government account submission and committed to engaging stakeholders for update. However, the Auditor General maintained the recommendation, emphasizing the need for comprehensive reconciliation and strengthen interagency coordination. This error cannot be committed. So the Controller Accountant General is literally saying that, hey, listen, after we submitted the financial statement, then things came up and we sort of realized that we had overstated maybe the public debt. But Auditor General is saying that, hey, you can't commit this error. That is a significant amount of money, 139 billion Ghana cedi. You cannot commit such errors. And so what does this mean? Economically, an overstated or overstatement of debt can lead to an exaggerated perception of fiscal risk, potentially increasing the government borrowing cost in international markets or negatively impacting credit ratings. It also misleads citizens about the true extent of national liabilities. Because if government is going to borrow money, they are looking at your current debt. And here you are, your debt has been overstated by 139 billion Ghana cedis. And so your fiscal risk high. Your borrowing rate is going to be high. And guess what? The public, as I was saying earlier, one of the things we said was that, hey, the previous administration, they borrowed. Why? Because our debt has gone up from 120 something billion Ghana cedi to whatever the heck, about 800 and something billion Ghana cedi. But in all these, there is an error of about 139 billion Ghana cedi. And that is misleading. And this is one of the key issues that the Auditor General raised concern about. Now, two things could be happening. It could be true that the debt has been overstated because per the Auditor General, they were not able to verify a lot of the debts that they claimed they were having. It could also be that it has not been overstated. Probably that is the real thing at the end of the day. And so what are some of these overstatements? For instance, external debt has been overstated by some 1 billion, 1.7 billion. Domestic debt, overstatement there. Cocoa board loan on external debt, that has been understated. Domestic cocoa board loan, overstatement. Grand total overstatement, about 139 billion of the public debt. So external debt, domestic debt, cocoa board loans, both on domestic and external debt, these are the figures that were overstated. That was the first thing that the Auditor General raised concern on, which is the overstatement of public debt. Again, what is the relevance for us? IPSAS 1, it mandates faithful representation of the entity's financial position. Section 54 of the Public Financial Management Act 2016, Act 921, also requires full and accurate reporting of public debt. So when we are preparing the financial statement, It is important that the financial statement we are preparing faithfully represent the entity's position. When we are preparing the financial statement and recording the public debt, which is going to go under current and non-current liability in the statement of financial position, we must make sure that it includes the full and accurate public debt of the country. If not, then the financial statement we are preparing is misleading. If not, then there is an exaggerated fiscal risk. If not, then the government's borrowing rate will be higher. So government will be borrowing money at relatively higher interest rate. This was one of the reasons for the qualified opinion. Number 2, misclassification of impairment loss as provision for investment. Now, I don't know what happened here. Yeah, the Controller Accountant General made a statement about why he did this, but I want you to pay attention carefully here because when there is impairment losses are written off. We don't provide for impairment losses for investment. You know this. When there is impairment, you don't make provision for impairment because provision is that there is a present obligation. You owe someone, you're going to be paying for it sometime in the future, and so you are making provision for it now so that when it becomes due for payment, then you pay for it. Impairment loss means that the value of the assets that you have has reduced, and hence you have to write it down to reflect it, and that must be done in the statement of financial performance. But for some reason, the Controller Accountant General misclassified impairment losses as provisions for investment. So let's look at what the Auditor-General said. The audit identified that Controller Accountant General, during the consolidation of the 2024 whole of government account, recognized an amount totaling 74 billion as provisions in relation to investment instead of correctly classifying it as an impairment loss in accordance with IPSAS 41. This amount was split between current liabilities and non-current liabilities. Look at it. Because you see, IPSAS 41 requires entity to measure the loss allowance for a financial instrument at an amount equal to lifetime expected credit losses if the credit risk has significantly increased since initial recognition, and to recognize this in surplus or deficit as an impairment loss or gain. In contrast, IPSAS 19, which is provision, defines provision as a liability of uncertain timing or amount resulting from past events. And so the misclassification was attributed to a misunderstanding of the appropriate accounting treatment for the impairment of financial assets versus the recognition of provision for liability. And this is one of the reasons for the qualified opinion. And as I said, when there is impairment, 74 billion, when there is impairment of investment, it's written off. You can't provide for that. Look at what the Controller Accountant General said. The Controller Accountant General acknowledged the recommendation, explaining that these provisions were in the books of state-owned enterprises and require thorough assessment and parliamentary approval for write-offs. Now, so look at what the Auditor-General said. However, the Auditor-General maintained that the requirement for parliamentary approval for write-off does not prevent compliance with IPSAS 41 recognition criteria, and that the necessary ledger should be maintained until such approval is obtained. And so, yes, Controller Accountant General, Auditor is saying that, hey, listen, I understand what you're saying. It's in the state enterprises, their books. We need a thorough assessment, parliamentary approval for it to be written off. But that is not what IPSAS 41 says. So you need to account for it in accordance with the way the IPSAS is saying, not what you think the law is supposed to say. So you can write it off later on, go and obtain the parliamentary approval. Because if it is write-off and Parliament must approve it, they're going to be approving it all the time, almost all the time. Now, so this indicates a systemic reluctance to fully reflect adverse financial realities in the statement, undermining transparency and suggesting a need for more advanced IPSAS training for preparers, particularly concerning financial instruments. That's very true. So Auditor-General is saying that, hey, listen, we need to train people on the IPSAS, especially about financial instruments. Financial instrument is one of the accounting standards that is really, really special, right? Even in the private sector, financial instrument, we have three different standards, right? We are dealing with IAS 32, financial instrument presentation. Then we have IFRS 9, that is financial instrument measurement and recognition. Then we have financial instrument disclosure. And financial instrument is, one of the trickiest accounting standards. So Auditor-General is saying that, hey, listen, Controller Accountant General, you cannot provide for something that is supposed to be written off in accordance with the standard, although you claim to be waiting for parliamentary approval. And that is the second issue that you need to understand. So again, you are seeing the correlation between what the standard says and what the law is saying. And so the best practice that the Auditor General is putting across here is that, hey, listen, yes, number one, you are breaching the rules of 41. The thing is not a liability that you provide for it. It is not like, government, these state entities owe somebody 74 billion Ghana cedis. It's not that they owe someone 74 billion Ghana cedis, so provide for it. No, because what the Controller Accountant General agreed and did in the books was to the effect that the state-owned enterprises owe people 74 billion Ghana cedis. But they don't owe anybody. It was an impairment of their investment. So you don't provide for that. You have to write it off in the financial statement in accordance with IPSAS 41. And that is what we must understand. That all the time, the accounting standard, once we are applying the full accrual basis, the accounting standard will take precedence, and we must account for the transaction based on what the standard has said, not based on someone's agenda or someone's goal. Because if not, there will be a lot of misstatement in the financial statement. Because now, it means that this forms part of the liabilities of government. Okay, this 74 billion is now forming part of the liabilities of government. But it's not part of the liabilities of government. So if somebody is looking at the financial statement of Ghana for the year ended 31st December, and they are calculating gearing or debt per capita, and they decide to look at all the debt of the country, then the debt has been overstated by 74.2 billion, which is not supposed to be the case. And so that is why the Auditor General said, hey, listen, on the basis of this, I'm going to issue a qualified opinion. Number 3, the Auditor General raised concern on lack of impairment review for tangible and intangible fixed assets. Now, this is what happened. The Auditor General noted that Controller Accountant General did not perform impairment test on non-financial assets during the preparation of the financial statement. This is a fundamental responsibility. Impairment testing. Because at least once a year, the non-financial assets must be tested for impairment so that in case they have suffered an impairment, they will be written off. Why? Because an asset cannot be carried above its recoverable amount. So why didn't the Controller Accountant General perform an impairment test? Okay, let's see. IPSAS 21, impairment of non-cash generating assets. IPSAS 26, impairment of cash generating assets, require public sector entities to assess at each reporting date whether there is an indication that an asset may be impaired. If such an indication exists, the entity must estimate the asset's recoverable service amount and recognize an impairment loss if the carrying amount exceeds this value. And then IPSAS 31 also mandates annual impairment review for intangible assets with indefinite useful life or those not yet available for use. This is the standard. Remember, Controller Accountant General was preparing the financial statement using the full accrual basis IPSAS. So if you are using full accrual basis IPSAS, why are you ignoring the requirement in IPSAS 21 and IPSAS 31 in respect of reviewing the impairment, reviewing or performing an impairment test on the financial assets. Why? Why? So let's look at the reasons that the Controller Accountant General gave. The Controller Accountant General acknowledged the operational complications associated with impairment review for tangible and non and intangible fixed assets, stating that it will require time and a well-structured process. Look at this. It will require time and a well-structured process. Does it mean all this while we have not put in place any procedures, any structure in place to carry out impairment testing on assets? What is the state transport company doing? It's one of their services. So why can't we engage them to value the assets of all state enterprises and all government ministries, departments, and agencies? And so this excuse by the Auditor-General, by the Controller Accountant General, cannot be accepted because it's one of your primary responsibilities. And so look at what the Auditor-General said in return. The Auditor-General reiterated the recommendation, emphasizing that merely defining impairment and developing processes is not sufficient without actual assessment and disclosure. That's the thing. Because you have to do it. And so requires time. What do you mean it requires time? That's your job. Okay, that's your job. Now, a failure to conduct impairment test on such a massive asset base, 772.83 billion, indicates a significant gap in the government asset management life cycle and IPSAS compliance. Because it means that there are certain assets that may not have any useful life, but they are still being carried. There are certain assets that may be rotting in the bush somewhere, but they are still carried in the books of the ministries or department or agencies. You know this, right? You go to the ministries, you go to various government agencies, metropolitan assemblies, and you will see there are some cars just parked there rotting. There are just some car parked there not doing anything. But if there is no impairment test carried out, it means all of those cars are included in the asset base of the country. And so government will be thinking that, oh, look at our asset base. Look at our asset base. Give us money. Give us money. Then the people will come, carry out an audit and realize that no, although you claim to have asset base of 773 billion Ghana cedis, when we check, it is actually like 400 billion Ghana cedis. Oh, who did that? Controller Accountant General. And so impairment testing is primary, is fundamental, is crucial. That is why if we are preparing the financial statement in public sector accounting and finance, in the notes to the financial statement, sometimes these are going to be there for us to work on, right? So, for instance, inventory, which is IPSAS 12. Inventory should be carried out lower of cost and net realizable value if the inventory is going to be sold, right? Or inventory will be carried out lower of cost and replacement cost if the inventory is going to be used or distributed for free by the entity. And so if you don't do those things, then you are overstating your asset, which is not a good thing. This suggests a fundamental weakness in asset valuation and stewardship. That is the third concern of the Auditor-General. So let's go into the fourth concern of the Auditor-General. Now, this one was non-recognition of income tax and VAT receivables. See, so the more you dive into the Auditor-General's report, the more you question some of the things that are done in the financial statement of Ghana. Because and you're going to be learning this if you have not already in public sector. One of the fundamental IPSAS that we're going to be looking at will be IPSAS 23, which is revenue from non-exchange transactions. And it simply means that since we are preparing financial statements on an accrual basis, the total revenue must include all revenue receivable by the government. And then the receivable figure on the face of the statement of financial position must include that figure. So for instance, if government has assessed any amount of tax, but has not received the money yet at the reporting date, that amount that has been assessed, since the tax has already been assessed, it means the entities, the individuals, or the government. And so that should be included as part of the tax revenue of the government, and then included also in receivables. Then if the government is going to be making any provision for irrecoverable debt, because some of the tax that have been assessed, not all could be collected, then they could make the provision for bad debt. It will be subtracted from the receivable and recognized in the statement of financial performance. That is what IPSAS 23 is about. But what is happening in the 2024 year end is that there was no recognition of income tax and VAT receivables. What does that mean? It means that the Controller Accountant General did not recognize receivables in the whole of government accounts in respect of assessed but uncollected income tax and VAT at 31st December 2024. This practice persistent despite the financial statement being explicitly stated as prepared in accordance with IPSAS accrual basis. If you are preparing a financial statement on cash basis, then assessed but uncollected income tax and VAT should not be included in the financial statement. But if you say that you are preparing a financial statement using the IPSAS accrual basis, then you are supposed to include that in the financial statement. Now, the big question is, why is this important? Because you see, the impact of this non-compliance is significant. It leads to understatement of tax revenue and non-recognition of tax receivables, resulting in the misstatement of assets in the financial position. Furthermore, the continued use of cash basis for tax revenue recognition directly constitutes non-compliance with IPSAS. Because it's like Controller Accountant General is using cash basis for the tax. Okay, the one we've collected, that is what we will use to account for it. But that is not what the IPSAS says. Now, listen to what the Controller Accountant General said. The Controller Accountant General acknowledged the audit's recommendation for compliance and committed to working with the Commissioner General of the Ghana Revenue Authority and the Ministry of Finance on the necessary improvement measures to recognize income tax and VAT receivable on full accrual basis in line with IPSAS 23. This is a fundamental breach of accrual basis of accounting, which Ghana claims to have adopted. You don't need any Commissioner General, any Finance Minister. Have you assessed the tax? Yes, we have. How much is it? Include it in the revenue. Do you want to make provisions for or irrecoverable? Yeah, make provision. So maybe we've assessed that tax outstanding is like 80 billion Ghana cedi. Okay. Double entry for that is to debit your receivables, right? And credit the tax revenue with the 80 billion. Now, Controller Accountant General can say, out of this 80 billion, we are likely not to get 30% of that. So we will make provision of 30% of it and only recognize 70% on the face of the statement of financial position. Do it. That is IPSAS 23. So do the right thing. And so this impacts the credibility of reported revenue figures and the ability to link tax policy to actual financial outcomes. So this is one of the reasons for the qualified opinion. Non-recognition of income tax and VAT receivable. A breach of the fundamental principles used in the preparation of financial statement accrual basis. Again, for the purpose of our public sector examination, when we are preparing financial statement, we are going to be doing the right thing in accordance with the IPSAS. As to why Controller Accountant General is not doing it, that is not supposed to be the case because he is supposed to know better or she is supposed to know better at the end of the day. But that is what we must understand in respect of that point there. Number 5, understatement or overstatement of cash and cash equivalent. So at this point, we are going into the cash flow. And the cash flow statement also, per the Auditor-General's findings, the statement disclosed an overstated cash and cash equivalent of 11.3 billion Ghana cedi. Now, why is this crucial? Because the cash flow is crucial. When government is making a policy, deciding how to allocate money to all the covered entities, whether to go borrow money and all of those things, its cash and cash equivalent balance is crucial. Here we are, the cash and cash equivalent balance has been overstated by 11.3 billion. 11.3 billion. So what it means here is this. That government is going to be thinking, policymakers are going to be thinking that, oh, Ghana has some 11.3 billion somewhere. And we can use that for something. Only for us to go and there's no money there. Why? Because of the misstatement that has been undertaken. So IPSAS 2 cash flow statement emphasizes that information about an entity's cash flow is crucial for users to predict future cash requirement, assess the entity's ability to generate cash flows, and understand its capacity to fund changes in its activity. And so flawed cash flow data can lead to poor strategic choices, including inappropriate capital investment, mismanagement of working capital, or incorrect assessment of financing needs. So maybe government is going to borrow money, but government will say, oh, we have money in excess. So instead of borrowing maybe 50 billion, government will borrow 39 billion because they know they have 11 billion somewhere. Only for the money to come and they will realize that, the 11 billion we thought we had was not actually there. And so the question that we then have to ask ourselves is, what is happening here? Is it that somebody has taken the money? This is where the politics, the gymnastics comes in, right? Because people will be asking, is it really an overstatement, as it is said, or somebody has embezzled that money, or what? Now, listen to what the Controller Accountant General said. Controller Accountant General stated that the accounts were updated based on audit observation and further investigations, which invariably impacted some line items in the statement of cash flow. However, the Auditor-General reiterated the recommendation for accurate cash flow reporting, noting that even after management adjustment, a material overstatement persisted. So I don't know, but I think there is a lot of issues that must be dealt with on the overall. There is a lot of issues that must be dealt with. I don't know, maybe some training, as the Auditor General has suggested, will be crucial for people to do their job well. Okay, maybe we don't have a lot of professionals, a lot of people who understand how some of these things are supposed to be done. Some of these reconciliations should be done. Some of these reporting should be done. I don't know. Maybe we have a lot of incompetent people working at the Controller Accountant General Department, resulting into these significant errors in the financial statement. Because look, you are breaching IPSAS 23. Look, you are overstating cash and cash equivalent. Because when this thing happened, this volatility in cash figures undermines the very purpose of cash flow statement, which is to provide reliable information for liquidity management and financial planning. And this indicates a control environment that is not robust enough to ensure the accuracy of even basic financial elements. This is a crucial thing. You cannot make this mistake. It cannot be done. Because government is going to be thinking, we have 11.3 billion, but the money is not there. And so if care is not taken, you see the government in power saying that, the previous administration, somebody has stolen 11.3 billion. Then they will come and make noise. If care is not taken, somebody is going to be arrested and detained more than the time they are supposed to be detained. Then later on, they will realize that, nobody really took any money. By then, they have defamed somebody. They have let somebody go into stress and all that. And what did we get on it? Propaganda. And so we need to have trained people, qualified people, to make sure these things are not repeated. Because if it is not money that somebody has taken and it was really an error, this error should not be committed. We cannot allow this to continue. Every year, the Auditor General's report always raises concern, and it appears as though someone is there and someone is stealing money. But for the most part, it's not like somebody is stealing money. It's just because people are not doing their job in the manner that they are expected to do their job. So either we fire some people, bring in more trained people, or we provide capacity building to the people who are already there to ensure they do the right thing so that we don't have to go over this again every year or year on year. That is very important at the end of the day. Number 6, non-disclosure of secured bond for deferred custom tax duties. Again, there are a lot of things. The more you go through this auditor's report, the more you wonder why the financial statements are presented the way they are presented. The audit identified that the Ghana Revenue Authority and the Controller Accountant General Department failed to disclose bonds issued to the government as security for deferred customs tax duties in the whole of government account. Again, this amounted to about 2 billion Ghana cedi as at 31st December 2023. Okay? And the whole government account does not accurately reflect the government's financial position, particularly its contingent assets or financial guarantees. Because this is money government is likely to receive. Because they've issued a bond on custom tax duties that they are likely to pay in the future. So it's a contingent asset that must be recognized in the financial statement. But hey, it's not recognized. So these bonds represent a form of financial guarantees and contingent assets, crucial for assessing the government financial risk exposure and potential future inflows. Lack of proper disclosures suggests either an oversight, a misunderstanding of financial instrument disclosure requirement, or a deliberate omission that obscures the true financial picture, thus misleading stakeholders about the government's collateral and potential revenue streams. This impacts the government's ability to demonstrate full accountability for all forms of financial instruments it holds or manages. You cannot breach the IPSAS in the preparation and presentation of financial statement because IPSAS 28 to 30 gives us information about financial instrument recognition, measurement, and disclosure. So why are you not doing it? And the Auditor-General is saying that a couple of things. Maybe it's an oversight. You didn't see it. Or lack of understanding of how financial instruments should be accounted for. Or a deliberate omission in order to obscure the reality of what is happening in the financial statement. And that is the thing we need to understand there in that case. Next one. Poor recovery of loan receivables. Yeah. The government lends money. Okay, so poor recovery. So a critical finding of the audit pertained to poor recovery of loans receivable by the government of Ghana. Out of a total of 63 billion, okay, give and take outstanding as loan, only 43 million, representing a mere 0.07 was recovered. That is really some way, right? This left an overwhelming outstanding balance of 61.1 billion, representing 99.93% of the total unrecovered. Government has lent money, but government is not collecting the money. Now, the poor recovery rate was attributed to the unavailability of debt collection strategy and a lack of consistent follow-up by the Controller Accountant General to the various covered entities and countries indebted to the government. Controller Accountant General, what are you doing? Are you not having the right staff there? Do you not have the enough people there? Then let's employ more people. People are owing, other covered entities are owing 61 billion, and you are not doing any follow-ups? You don't have any recovery strategy there? Why is this important? Because if care is not taken, these debts would have to be written off later on in the financial statement. Now, the key question you need to ask yourself is, who does government lend the money to? So I'm going to go through a number of things with you there. The category of people or category of entities, the government on lend loan to entities. So the government's, this includes entities like Ghana Railway and Port Authority and local authorities. Okay. Statutory boards and corporation. That is a lot of state-owned enterprises and statutory bodies like State Farm Corporation, News Time Corporation, Ghana Enterprise Development Commission, Agriculture Development Bank, State Transport Corporation, National Investment Bank, Ghana Post, Ghana Water and Sewage Corporation, Ghana Airways Corporation, Ghana National Petroleum Corporation. The list is very tall. Private entities and companies. The government also lends money to a wide array of private companies across various sectors. Examples include Ghana Sugar Estate Limited and its branches, Africa Timber and Plywood, Mackenzie Fisheries, Quality Grain Co. Limited, Cummins Power Generation Limited, Home Finance Company, and various manufacturing and industrial companies like Prefarm Concrete, Achimota Brewery Company, National Oil Palm Plantation Limited. Okay. Then we have others. Financial institutions like Joabin Rural Bank, Fidelity Bank Limited, EcoBank, Cal Bank, energy sector companies like, Sunun Asogli, Aska Energy, Car Power, ECG Loan Recoveries. Like the list is pretty tall. Then other governments, right? The government of Ghana has also extended loans to other sovereign nations, specifically the Republic of Guinea and the Republic of Upper Volta, which is Burkina Faso. These loans are granted by the government of Ghana to these covered entities to support their efficient and effective operations. So these are the list. Are you getting it? So Ghana to state-owned enterprises, other entities, private organization or private institutions, other countries, and Controller Accountant General is not going after the money. It's not going after the money. There is no recovery strategy. And this money, 61 point whatever billion, is with these people. The whole of 2023, government collected 0.07%. Literally, it's like we are dashing the money to the people. No. There has to be recoveries strategies there. So the Auditor-General said the abysmal recovery rate of loan receivables represents a colossal loss of public funds and a severe deficiency in the government's asset management and debt collection strategies. This indicates a systemic weakness in lending practices, follow-up mechanism, and potentially a lack of political will to enforce repayment. Yeah, political will. Maybe some of those private institutions, there are some government appointees who have some interest in them. That's why they were able to get the loan. Maybe some of those public corporations, their boards will be appointed definitely by the government. So, they are reluctant on bringing them, and, it's like coming to wash our dirty linen in public. They don't want to do that. So there is lack of political will. Okay. Now, the Controller Accountant General said, hey, listen, they form a committee to put steps in place. But the Auditor General said, that's not what is needed. This issue is not merely an accounting problem, but a critical governance and fiscal sustainability challenge. Critical governance and fiscal sustainability challenge. And so when it comes to the accuracy of the statement of financial position and fair presentation of the statement, these are some of the things that Auditor General raised concern on. And you can see practically that a lot of the things are not just accounting issues, but also the way political factors may be playing a role here for some of the things, right? Because some of the things will paint the government in a certain way, or some of the things may not inure to the benefit of people who are put into places of position, especially the last one that we looked at, the debt collection issue. And all of these are crucial things that you need to understand. And so if you are writing public sector accounting and finance, advanced audit and assurance, you are looking at management, accounting, and financial management, these are some of the things you need to understand. In the next episode, we are going to be continuing and looking at the second part of the auditor's report, and we are going to be focusing on issues affecting financial performance and accountability. And there also, you're going to be seeing some few key issues that you need to understand. Remember, everything you are doing in class, in this ICAG professional qualification program, is not just something you are learning out of the blue. It's actually what is going on in practice. It is actually what you are going to be doing when you are in practice. And so it is to merge that classroom experience with what is practically seen in the auditor's report, so you can put yourself in the position to go into the exam hall, write the exam with confidence, and most importantly, pass the examination. And beyond that, be equipped with practical skills so that if you are put into the position and you are the one responsible for preparing financial statement, you will not say, hey, I won't do impairment testing. What the heck? You're supposed to do impairment testing. You're not going to say, oh, we have assessed property rate or tax payable, but we will not recognize it in the books. You will not say, oh, we were not able to reconcile something before financial statement was prepared. No, it was supposed to be reconciled before financial statements are prepared. And these are the things that you must understand to put you in the position so you can become successful. Thanks for watching. Thanks for listening. And I'll catch you in the next one as we continue with this discussion. Remember to like, subscribe, and share the video with others. And I'll see you in the next one.